Welcome back after the break. Now I want to talk a little bit about jet fuel. And the reason why that is such an important topic now is because it directly affects everybody who has any plans to travel. The crisis which is emanating out of the Straits of Hormuz is now rippling across the entire world and affecting the airline industry. But before I start talking about jet fuel, I want to just quickly tell you the difference between jet fuel and car fuel, just so that it helps us understand this situation better. Jet fuel is normally heavier, car fuel is lighter. Jet fuel has low freezing point, stable. Car fuel, of course, is higher freezing point, volatile, and more importantly, highly flammable. Jet fuel is less flammable. Anyways, now let's get to the real part. Jet fuel prices have gone up from $90 a barrel to $200 a barrel. That's the huge jump that has happened, and it is reflecting in the costing of the airline industry. Now, if you look at this graph, this explains airline operating expenses, and of the total expenses, 35% is fuel, jet fuel, and therefore, of course, higher the cost plus fewer flights means more expensive tickets, and that is why airlines are now raising fares, adding surcharges, and cutting flights. This is a crisis that is happening in real time. This essentially explains to you which countries are the key exporters of jet fuel. Of course, if you see the blue line, South Korea exports 250,000 barrels a day, by far the number one, and then USA, Netherlands, Singapore, India, Venezuela, and then at the end, of course, the Gulf countries. It is important to understand that, for example, South Korea, the raw material for jet fuel is crude oil, which comes primarily from the Gulf countries. Then the refineries, special refineries, converted into jet fuel, and those refineries then produce all the jet fuel that South Korea, for example, exports. Now, as a result of all of the shortages, here is a key figure that you need to understand. 75% of Europe's jet fuel is imported from the Gulf, and around 375,000 barrels per day. And in April, the import from the US was this much. Essentially, the bottom line that needs to be emphasized is that Europe, this is BBC reporting, Europe has maybe 6 weeks of jet fuel left. The energy boss has won. This is the real crisis which is developing very quickly, primarily because of shortages and price hikes. This chart shows to you jet fuel price development. If you start from April 24, you see it's a pretty much stable, all of this, and then suddenly this graph around here, March 2026, it just goes skyways. So essentially, this chart shows you the stability and then the sudden spike because of this conflict. This is a very serious issue, as a result of which, and here's where you and I come in. Anybody who wants to travel, well, there's the bad news. Ticket prices are going up, and going up by big margins. If you look at this one, for example, Islamabad to Dubai, these are average across all airlines. In January 2026, if you wanted to travel from Islamabad to Dubai, the ticket was 85,000 rupees on an average. In April, it is now 245,000 Pakistani rupees. So that's almost a 300% jump. This is huge. Again, from Islamabad to London, January was rupees 260,000, and in April it is now 360,000 and probably rising. And finally, if you want to go to New York, in January 350,000, and in April now it is 700,000 rupees. So that's the jump that has come. Again, we don't know where the situation will go because the crisis continues to unfold, and as you will hear shortly, even if the conflict ends immediately, the difference, the impact on fuel charges and ultimately on airline prices is not going to happen very soon. So buckle up. So let's now turn to another dimension of this crisis, one that may not look as dramatic as warships in the Strait or negotiations in Islamabad, but could have consequences just as far-reaching and in some other ways even harder for the world to absorb. Because while diplomacy is trying to prevent military escalation, the markets are already trying to price what escalation could mean. And that is where this story becomes much bigger than oil. What traders, governments and consumers are all watching tonight is not whether simply crude goes up a few dollars, but whether a conflict that began as a regional military confrontation is beginning to threaten the stability of the global energy system itself. The Strait of Hormuz remains under pressure. The US blockade has injected new uncertainty into shipping calculations. Iran continues to signal it has options if pressure intensifies. And layered on top of that are growing concerns about what happens if stress spreads towards Bab al-Mandab, creating risks at two critical maritime choke points at the same time. Nearly a fifth of globally traded oil passes through the Hormuz. A serious disruption there would not remain confined to this region. It would move through prices, freight, insurance, inflation, supply chains, and eventually into politics and households far beyond the Gulf. That is why the market is reacting not just to events, but to possibilities. The real question tonight is whether markets are correctly pricing risk or whether they may still be underestimating how serious the downside could become if diplomacy fails. What is the realistic best case scenario for oil from here? And what is probably the worst case? How vulnerable are global supplies if this crisis deepens? And at what point does volatility turn into genuine economic shock? Those are the questions we need to understand tonight. And there are very few people better placed to help us do exactly that. And joining me to discuss this is a very special guest, Mr. Humayun Falak-Shahi. He is the head of crude oil analytics at Kepler and is also a leading voice on global oil markets with deep expertise in crude flows, global market dynamics, and supply disruptions across the Middle East. He closely tracks real-time energy movements and provides critical analysis and insights into how geopolitical tensions from the Strait of Hormuz to broader regional conflicts translate into price volatility. So as you can see, he is the right man to actually speak on this topic. Mr. Falak-Shahi, welcome to our show.
Thank you, Fahd. It's a pleasure to be with you.
So I want to start with a question which I hope actually never comes true. If this conflict doesn't lead to a settlement in the near future, and the ceasefire gets broken and the war restarts, what is the worst case scenario we are looking at in terms of what happens to oil supply, oil flows, oil pricing, and effects on the global economy?
I think the worst case scenario is we're not there yet, but what we're in already is close to this, and it's really the closure of the Strait of Hormuz. Because as you know, before the war, you used to have roughly 16 million barrels per day of crude oil and condensate that used to pass through the strait to global markets. And since the beginning of the war, it's been extremely limited. So Iran was able to export its crude up until the US blockade got implemented last week. But even that oil from Iran now is not passing through, and going to world markets. And on the other hand, you have all the other countries in the region are only shipping very low level of crude. So we're talking about 200,000 barrels per day compared again with a level of 16 million barrels per day before. So I think the worst case scenario is if the war resumes, we could have the Iranians target production facilities in the region, which is something that so far they have not done that much. So except the Ras Laffan liquefaction facilities in Qatar, most of the other production facilities in the region have been more or less not so damaged, I would say. But if Iran damages production facilities or export terminals such as Yanbu on the Red Sea from Saudi Arabia or Fujairah on the Gulf of Oman from the Emirates, then we could see obviously even less crude reach global markets, and that means another rise in prices, in oil prices.
So we've seen a lot of fluctuation. Of course, we started from, I think, when the price, correct me if I'm wrong, I think it was somewhere around $70 before the conflict. Then it went up to as high as probably $130, $140, maybe even $150. And then it's been fluctuating very rapidly, directly linked to the sentiment or the perception of where this conflict is going. And I'm sure a lot of people have made a lot of money also, most likely. But if things get worse, do you think the price could go far beyond that it has gone to, and how high could it go, and what kind of a huge impact would it have on countries which are very dependent on oil from the Gulf?
If you look at the price action in the past 2-3 weeks, really since the ceasefire was announced, it's been actually, the market has been very complacent. I mean, you have Brent under $100 per barrel. You have equity markets at an all-time high in the U.S., for example, and close to their records in Europe. And so everything indicates that at least the market believes there is going to be a solution out there, and that the war is going to effectively stop. Maybe we'll see a deal, but that in effect we'll see a resumption of oil flows through the Strait of Hormuz. So this is already priced in. So this means that if there is no deal and the situation escalates from here militarily, then we should see a strong rebound in prices, indeed, and we should see equity markets probably crash from there onwards. And I think back to how high it could go. You're right in saying that prices are already pretty high. You have Brent under $100 per barrel, but the cost of physical barrels, in terms of imports, is already much above that. So, for instance, if you look at Pakistan, it's probably importing oil at a cost of around $120, $125 per barrel right now, but it used to be $160 at the beginning of the war, or let's say a month ago. So I think we could at least go to those highs if there is no deal. And potentially, if there is further escalation and the market believes this will last another few weeks, then we could reach to new highs, and so we could go above where we were a few weeks ago.
Mr. Falakshai, I think we've looked at the worst case scenario, and that's very depressing. So now let's see if we can be a little bit more optimistic. And here in Islamabad, in Pakistan, we have to be very optimistic because we are hoping that peace will break out from right here. So if we are optimistic and things work out, obviously that would reflect in confidence in the market, in the prices. Oil will come down. And we've seen that oil has actually come down very quickly also. So if there's actually some sort of a formal agreement, that would mean the price would come down. But how soon would that actually translate into the kind of normalcy that we had before the conflict? Because the general perception is that, if the market price goes down, it's going to take quite a while before people, at petrol stations will be paying the same kind of price that they were before the conflict. So what's that time lag generally?
I think it's probably we're talking about a few months. Even if there is, let's be very optimistic, as you said. Let's assume there is a deal, a formal deal, and full deal, which means that war stops and Iran opens the Strait of Hormuz. Even in this scenario, we think that it will probably take about at least 2 to 3 months before transit and passage through the strait normalizes. And that's mainly because it is a confidence issue for the maritime industry and the ship owners, charter, in order to take the risk of going through the strait. So we will see a huge jump, obviously, of passage. And we've actually started seeing this on Friday when the Minister of Foreign Affairs, Abbas Araghchi from Iran, announced that the strait was open. We saw a flurry of tankers going for the exit from the Persian Gulf and to try to exit the Strait of Hormuz. But then obviously, as there were conflicting rumors, conflicting news from Iran, and we had shots towards some tankers, then most of them actually backtracked and came back into the Persian Gulf. So I'm saying that we see a big jump, but for this confidence to rebuild, it will take probably, we think, at least 2 to 3 months. But then looking at prices, I would say that we probably will not go back to where we were before the war, even though we will see prices decrease. And right now we're at $95 per barrel Brent. We used to be at, you said, around $70 per barrel before the war started. I think the new normal probably will be around $80, $85 per barrel. And that's mainly because a lot of the countries which have drawn their inventories, they will be looking at rebuilding those stocks. And that means stronger demand on a more sustainable basis to rebuild the stocks as well.
But that also feeds into this assessment, Mr. Farag Shaheen. Maybe you can add to that. A lot of people are saying that it's almost impossible to actually go back to where we were because so much has changed. The economies of the Gulf have taken a hit. It will take a very long time for them to recover, not just materially, but in terms of their perception. The Straits of Hormuz has been weaponized. We now know that it can be used as a weapon. And the whole dynamics of the region and possibly also the oil market, they've all changed. Can they just go back to the way they were, or should we be ready for this new kind of a world once this conflict ends?
I think you're totally right. I think there will be a risk premium incorporated into prices of oil coming from the Gulf, from the Persian Gulf. There will be a risk premium for tankers wanting to go in the Gulf and load crude and come back to go to global markets. So that risk premium is obviously going to decrease if there is a deal, but is not going to disappear. So that is certain. And I think you are right in the sense that the perception in the region in terms of geopolitics will also has probably changed forever. And that's mainly because the Iran's neighbors now understand that in the long term they cannot plan accordingly as long as the Islamic Republic is around, because they know that whenever the Islamic Republic will be unhappy about something, there is the risk that they close the strait or that they bomb some of their facilities. So I think in the long term that this is probably one of the mistakes that Tehran has made, in the sense that it has proven to the world that it can close the strait. It can take the world hostage, if you may. But at the same time, it has proven to its neighbors that it can't be counted on the long term. And as you know, a lot of these countries, and especially in the GCC, like Saudi Arabia, the UAE, they have these long-term investment plans, which are obviously dependent on security in the region. So if there is no security on the long term, it is difficult for them to achieve these goals. And I think the geopolitics landscape in the region will have changed probably forever.
And finally, you're talking about geopolitics and how it's going to affect the oil industry and oil pricing and oil or the flow of oil. And also, of course, the search for alternates. I know I was speaking to some experts in the last couple of days also, and they all tend to agree that yes, there are alternatives, but actually there is no real alternative for the Strait for the Persian Gulf and the oil that comes from there. So the world will remain on the volume of oil that is coming from there. My question is, will the world also remain dependent on the petrodollar, or is that also something that may change or may have started to change by then? Are we seeing any trend where, for example, the Chinese yuan would make a greater entry into this whole geopolitical chessboard, or is the petrodollar still strong and will remain so for at least the foreseeable future?
I mean, there is a trend of de-dollarization globally that has started a few years ago with the BRICS group. That is gaining traction, I would say. But I would say when it comes to the petrodollar and the use of the dollar in especially in transaction in the oil market, I think it will really be down to a strategic decision taken by especially the likes of Saudi Arabia, UAE, Iraq. And if you think of Saudi Arabia and the UAE, these countries have had defense agreements with the U.S. And they may be in a situation where they think that that defense agreement, it hasn't helped us that much actually in the past few weeks. So maybe they would want to, go away a little bit from the dollarization of their transactions and maybe move more into using yuan from China, trying to get more strategic and more defensive relationship with China. Obviously, these countries have a very strong economic relationship already with China, but not really on the defense side. So maybe we could start to see these trends depending on their strategy. But at the end of the day, I think that obviously will depend on the outcome of how this war ends. But I think that the dollar is going to remain the most used currency for the foreseeable future in the world, even though that trend of de-dollarization will slowly gain traction.
Very well said. Mr. Humayun Falakshai, thank you very much. We are all hoping that the worst case scenario does not come true. The best case option actually materializes right here where we are in Islamabad. Always a pleasure to have you on our show.